webinar. For anyone who missed our previous webinars, give us a call and we can send the videos you missed. First things first, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read all disclosures before investing. If at any time during the webinar you have questions or trade ideas, type them into the chat box and we'll do our best to answer them. Also on the line today is our presenter, Mr. Adrian Mueller. He's the founder and principal of Time Leverage Capital, who was the chief strategist of Dow Jones Megatrends and All Markets newsletter, and lead developer of the Option Ranger software. Mr. Mueller?
Thank you, Roy. Today we're going to be doing a follow-up on selling call options, or also known as writing or granting call options. This is one of the four principal pillars of option trading. It's a one-leg trade. Those four main trades are buying calls, writing calls, buying puts, and writing puts. And just to review, we're going to show you the scenario when this kind of a trade should be considered. We also have a recording of a more fundamental discussion, but we'll go over basics today as well. Right now, we find ourselves in our strategy gallery, which is where you take your outlook on the market and come up with a strategy of how to approach that particular market using either an outright option or some kind of an option spread. To review, and this is a grid that has been presented by multiple exchanges and sources over the years, but is not always very easy to understand. What we've done with the Option Ranger is we've taken this grid and put some numbers to it, because actual examples and numbers, calculations, even if hypothetical, will get the mind more wrapped around the concept than a chart. So as you can see here, we look at two factors, as should anybody, when selecting a trade strategy. The first is, as you can see here, is what is the direction? What is the direction of the market? And there are only three possibilities. Market can go up, it can go down, or it can be undecided, trade sideways. When you get into a trade, one of the reasons you might begin a trade is because you have an opinion about direction, which could be any of these three opinions. There's a second factor that is extremely important in all speculation, but even more important when talking about options, which is not just your outlook on where is the market going, up, down, or sideways, undecided, or along with an equally important, sometimes even a more important question is, what is the volatility outlook? We had a couple of webinars in the past on volatility. I refer to it as the bounciness of the market, the expectations that are built into the market. Volatility goes up when markets start getting more crazy, when they prices start moving in larger swings. And option valuation also goes up if there is a major anticipated event that makes people think the markets could make very large moves. So you might see increases in option volatility ahead of a major report, or perhaps in anticipation of some major geopolitical event. In this particular case, when we are looking at selling a call, we are looking at a trade that has two primary features. And here we are. You see the example of selling a call or shorting a call, granting a call. One of the expectations is that the market is going to go down. So this is, to some extent, a bearish trade. But if you expect that the market is going to go down, but not go down in a huge way, if you think it might be a small drop or maybe a flat market, you wouldn't do something that relies on rising volatility, like buying a put. We did an example of that, or a put ratio back spread, which is a combination trade. If you think that the market's going to quiet down and you want to be bearish or maybe bearish neutral, there are two strategies, and you can see they cross-reference. They're in the bearish column under volatility falling, and you would have two scenarios. The ones that we are going to follow today is a short call. When you sell a short call, that means that you think the market's going to go flat or down, and that the volatility or the anticipation of crazy events in the market is going to diminish. When you go through this grid, if you want to get further detail on the strategy, you just click on the strategy, which is selling a call, and when you click on it, you open up a page that gives you further detail on how selling a call works. So first of all, the type of trade this is directional, meaning you have a sense of where a market is going. You can put on certain trades where you have no opinion as to direction, but based on volatility alone, you can do a trade. In this case, you actually have an opinion. You think the market's going to go down. When to use, and again, we have a very quick explanation here. Basically, believe the market is not going up or will not reach the strike price anytime during the option. So basically, although this is a bearish trade, it can do all right if you sell an option out of the money or at the money and the market doesn't move or moves very little. You can still profit because of time erosion. Now, the profit potential is limited to the amount of premium collected, and you're going to see that on the spreadsheet. So whenever you sell a call, whenever you sell a put, your profit potential is limited to the net that you collected on the option, which is the premium that you were paid, and we'll see it on the spreadsheet, along with the other transaction costs for writing the option. This is, however, a margin trade, which means that if you sell an option, if you sell a call option, that's a margin trade, and your loss potential can be unlimited if there is a huge or explosive move, in this case to the upside, and then your option could go upside down significantly. The time decay in this case is on your side, meaning that the more time that passes without the market making that big move to the upside, that volatile move to the upside, the more time decay will work on the position, and as it decreases in value, you gain because you sold it for a higher price, and you should be able to either buy it for a lower price with time decay and no move, so you could either buy it back at a win, or if you want to hold it to expiration, let the position expire worthless, and you would keep the premium. There was a study done by the exchange across millions of options in uncorrelated market in which it was noted that 76.5% of all options expire worthless. So while there's certainly a degree of, there's margin risk in writing options, as you can see, the reason people take that risk is twofold. Number one, they do collect premium on the trade, and with time erosion on their side, options in general expire worthless more often than not, according to the large CME study. And then you have a further definition at the bottom of writing a call option. This is a good review before you put on a trade. If you want to know how to input a call option, I would like to call your attention to our reference material section, where you have a number of brochures, option sheets, demo videos, market details, and we have a specific demo in there actually, which was done previously with very professionally, with a full explanation of how to input this kind of a trade and all of the features of the calculator that help you view that trade. So now let's go ahead and I'll actually do an option writing strategy of selling a call, which we can do on our regular option calculator. Now, let's begin this trade from scratch, although we had some saved trades previously, and we can visit one later on to see how it was doing. Any trades that we save here in the Saved Trade tabs or that you see in the various calculators are trades that we can add to your grid. You can add your own trades to the grid, and we can follow them and see how they do. In today's case, let's go ahead and have a look at Oh my goodness, I think I opened our basic stock option calculator. By the way, we do have stock option calculators as well. We have a futures and basic calculator. We have a spread futures calculator, and we have the same on stock options and stock option spreads. In this particular case, let's go to the futures basic option calculator so that we can go ahead and model out a selling call trade. And I see that we have some previously on selling calls and selling puts. The last example that we did, by way of example, let's see if we can follow it up, was on the 21st, and let's see what we did on January 21st. We did one example of selling a 1900 S&P call. This is the last time we did a sell call webinar. So let's pull up that trade and see how it looks. It's a good feature so that you can simulate trades. Again, these are not recos, or they're for illustration purposes. At that time, the trade that we did was on the S&P 500. We sold one call. The strike price was 1900 on the S&P, so this is at a time that clearly the market has since dropped. This was an out-of-the-money option consisting of time value only. It was sold for $7.75, and we used these inputs for a commission at a default of 55. And after we saw all the trade details, the net credit on the trade was $1,882.50, $1,882.50. This was the value on settlement on January 21st, barely 2 weeks ago. And obviously since that time the market has had a correction. It's been bearish, and although the volatility has been higher, chances are that this option has decreased in value because of bearishness. Roy, can we pull up a quote on this just so we get a sense of updating this position?
It's actually trading at less than 1 point right now. It's at 0.85.
Okay, so if it's at 0.85, let's call it 1 point. That would mean that you would have cleared 7.75 points. So you can take your 1882.50, subtract 250 from it, and that would be your net. Again, that trade would have, in a relatively short period of time, picked up a great deal, because although it wasn't correct in terms of being both bearish and having falling volatility, it was bearish with rising volatility, but the bearish part and the fact that this option was out of the money to begin with would make that trade a winner. In all likelihood, you would want to offset that and not hold it to expiration, although you certainly have the option to do so. When you sell a call, you have the right, but not the obligation, and you can see all this terminology both in the strategy gallery that I showed you, and you can also find those definitions under our reference materials under option sheets. So now let's look at what happens, and we're going to clear this trade. We're going to reset this trade, and we are going to try to come up with something else. And because, again, we have a market which is highly volatile, let's assume for argument's sake again, and we've had a lot of these questions from people who think that the market's going to continue to correct to the downside, or that if it rallies, it won't rally much because people are somewhat nervous of a correction. So I think that we can go ahead and try again on modeling an S&P call right and see if that would still make sense in this environment. As you can see, when you work with the option ranger, you can just start inputting the symbol, or you can go down the drop-down menu until you get to your symbol. The minute we input the contract market, you get the complete contract specifications, tick values, and there's a link. Whenever one of these help boxes opens, you know that it'll take you further. In this case, if you click on complete contract specs, it'll take you to a full contract specs, trading hours on the S&P, as well as a news grid and essential things to watch when trading the S&P. And in fact, I'm going to go ahead and just open that briefly to give you a sense of the next page, and then we're going to go ahead and come back to the current strategy. again, what the strategy that we are going to be looking at. Hold on just a moment. What we have here is what you open when you open that window is you have a symbol of the S&P. You have the trading hours, the tick values, and so on. And on the right side, under the What to Watch section, is our proprietary list of key indicators that we've compiled while putting together Megatrends for Dow Jones. When you click on some of these enabled hyperlinks, you go to the primary source where that particular fundamental is discussed. This way you can go straight from the strategy to selecting the particular trade you want to do and to seeing the particulars of the contract and the fundamentals of the contract all through one interactive screen. Next, we are working today on this strategy, which is selling a call, and very helpful. As you'll notice, what happens the minute we select that strategy, we get a reminder graphic of what we initially saw in the strategy gallery to remind us of the profit and loss graph of this trade, and to remind us that time decay is important in this case, and to remind us that we want the direction to be down and also the volatility to be down. And when you see this, you see it very quickly as a reminder on a graph. The more you see it, the more it's going to hit naturally of how this is supposed to work. In the meantime, you can click on that box and go right back to the strategy gallery and get the definition. So let's go ahead and select one contract. And let's see, what's nicely out of the market? The market's just under 1750 right now, basis March. What kind of an option is going to give us a premium of approximately 10 points in the S&P, Roy? I'd say we'd want to collect a good $500 on mini, but since we're looking at the large, let's go ahead and go for about 8 points.
I would say the 1820 call then.
Okay, so we're looking at the 1820 call. Now, when we select strike price in the box, as you can see, one moment I put the cursor inside the strike price box, a legend shows up that explains how to input the trade so that it's going to pick up the calculations correctly. And again, if you click inside the help box, you will be able to get information about strike prices and classes of options. We've also done programs on in, at, and out of the money options and how to pick them. When you select the premium box, again, having selected the other box, you'll notice that we immediately get another help dialog box which tells us how to input the premium price. So in this case, we were looking at 8 points.
Yes.
Okay, so I'm just going to input 8. There's no reason to input the decimal. That's implied. But if it was a fraction, then you would put in a decimal in the next number. Then we'll input our costs at a default, let's say, of 55. And let's calculate and see how this trade would pan out. Okay, and I want you to notice one other thing. So we're going to do this calculation. Okay. The first thing that you're going to notice again is that the minute that trade is calculated, it appears as a saved trade with a date. So we know that on February 4th, we input this trade, and whether you're monitoring in real time or whether you are paper trading, you will know what you attempted or what you were modeling and at what price. If you want to model these with updates in real time, be sure to contact our customer service desk and to request a real-time platform and a real-time paper trading platform. If you are trading in real time, then obviously you're going to see these trades in real time on your regular account statements. So again, there are ways of inputting the trades here, modeling them, and what I recommend very strongly is that if we're not trading in real time, that we certainly track it in real time for those who are using this strictly for educational purposes, which is really our intent. So now let's see, once we've input this trade, we've collected 8 points. Again, we've indicated that it's $250 a point. We have the tick values here. So this person is collecting $2,000. When you sell that call, you are betting that the market is going to stay under 1820 by the March option expiration. And if it does so, then you would net $2,000 minus your commissions and fees, which were input. Again, that's the way of knowing the cost of doing business. In this case, if filled at these levels, you would collect $1,945, and that sum would be yours to keep if by expiration the market is under 1820 in the S&P, which is about 70 points away. Now let's look intrinsically. Now this is also trading on premium, so we factor in your premium cost of 7.78. So for instance, as in the earlier discussion, you can constantly track the premium price, and if you find out, for instance, that at some point this option is worth a point, you might say, well, I've made 6.78, I can come out on premium and not wait for expiration. And we also list the futures break-even point at expiration for intrinsic value, so you have both the premium and the futures at expiration break-even points. In the futures at expiration, the number is 1827.80, and that's because we take the 778 that we collected, we add it to the 1820, which is the strike price, and that's how we get to 1827.78 as a futures break-even. The most you can make, as we discussed, is the premium collected, which in this case the net premium after these costs as listed would be $1,945, $1,945 on a one lot. The loss intrinsically on the futures would be $25 per tick move above 1827.78. So if you sold such an option knowing that you have a significant and unlimited risk above that level, you would have to be on the lookout for any rallies and have a strategy in place to offset and be prepared that if there's a large move, that could have a significant impact. Now we're going to the spreadsheet, which is really where people can learn a trade. And as you can see, it's pretty clear on any kind of a price drop, because this is bearish with falling volatility, any kind of a price drop whatsoever, you would retain the maximum of 1,945. Where, and in fact, even on a rally, so although this is a bearish strategy, if on expiration day the market is at 1816, you would still make $1,945, or you would get to keep that premium, although the market from here to there would have had a rally from, let's say, 1750 to 1816, would have had a rally of 66 points. Pretty decent move in the S&P, although the last couple of days have been volatile. So even if the direction is mistaken and the market rallies, but does so slowly and with falling volatility, even being wrong on direction, you have that margin of error. It's like it's basically collecting in that premium with a margin of error that you could still make your maximum even at 1820, and then you would start losing. You don't automatically lose at expiration if the market breaks above 1820. You do have a cushion of $1,945 or 7.78 points to absorb before you start actually not just giving back from the money that you have collected, but actually start dipping into the pocket for losses. And as we indicated, those numbers begin around 1827.78. So what I would do is monitor a trade like this closely.
Mr. Mueller, I think we've lost your connection.
Hello?
You're good.
Okay. So just to repeat, so again, you would have to have alerts at various times along this grid and at various premium levels that if the outlook is mistaken and the S&P would go up or go up with rising volatility, there would have to be triggers to offset the positions or to use some sort of risk management. The risk, of course, is that if somebody writes that 1820 call and collects the 1945, but the market for some reason, contrary to expectations, begins to rally, and there are no offsets and there's no risk adjustment, for argument's sake, if that market gets to 1840, again, which is a pretty significant move, but anything is possible now, there would be actually a greater loss than the initial money collected, and so on and so forth on a move. So in this particular trade, you have a large margin of error to make money, all the way to 1820. You have time erosion in your corner, so you have a lot of things going for you, but you can't go to sleep and have a big move catch you unawares. Because when volatility goes up, so does the precaution level on the trade. Now, because I want to save this trade under a tab, let's see what we have here. Okay, so we have a sell call demo section here. So I'm going to go ahead and show you how we can save that. If you want to monitor a trade under a category, you can just save under tab. Then you select the sell calls box. You save the trade. And from now on, you'll know that if you want to have a look at that trade again, there it is. And in fact, you see that we saved some of the 1900 calls in there as well. We'll probably take them out next time so that they don't clutter the screen, since somebody doing that trade in all likelihood would have offset by now. So the other thing that you can do, and again, I just want to demonstrate this, it's very important as a feature. Once you've saved this trade for yourself, either on a regular tab or under a special tab, or we can save them for you if you have particular trades or particular analysts that you want to track, you can email this trade to a friend. I find that it's great when people are working in the markets to have one or two friends that are pursuing the same course, maybe using the same software, work together as a team, talk out trades, exchange trades by email. You can also print out the trades so you can look at them, or look at them with your fellow traders, and mark up a piece of paper, which I enjoy doing. And of course, you can take all of your ideas, and along with exchanging ideas with your friends and trading buddies and partners, you can post a trade to a forum and get some feedback on the trade from other people using the service. So for instance, if somebody were to put up this trade and send it to somebody, or post it to a forum, let's say somebody else comes up with a different opinion and says, I think this is really an interesting trade, but I'm not sure, I think it's a tough market. I think I would rather go ahead and do this with the E-mini S&P. I don't want a contract that is so large, maybe the risk is too much for me. So then what you do is you can go into the mini S&P. As you can see, the tick value is different. It updates right away with a different tick value. We reinstitute the idea of selling a call. Okay, we're still selling the same call. We're going to figure the same costs, although usually those are discounted out. And let's go ahead and calculate this trade now and see where it brings us. Again, we have a whole different math now. We're only collecting $400 gross, and after we deduct the cost, it's $345. You're collecting a lot less. However, let's check the risk level as well. In this particular case, while your break-even levels are in the same zone, slightly different because of the percentage of this that is the cost, because it's a small contract, your premium break-even is 6.9. The futures break-even is 1826.9 at expiration. And you see your risk is a lot smaller. It's 1250 per tick. In this particular move, as in the previous example, the market can stay low, low, low up to 1820, and you still make your full 1345. And then when you start getting above your 1826.9 level, you begin to incur losses. As with most things, and this should make perfectly good sense, in this case, if the market gets to 1840 and you don't offset or you don't make some sort of risk adjustment, as you can see, your losses are also smaller. They're at 655. At 1850, they're at 1155. That's a pretty good size move. So there is an advantage, and there is something to always consider in using less leverage. 345 is significantly less than 1945 on the other trade. So what you can literally do is you can go back and forth between the two trades. You say, well, if it tanks, I get 1945 on this one, but I only get 345 on this one. But then let's say you want to go back and look at the risk scenario, put them right side by side. You can say, oh, well, at 1840, which is maybe an outside number, this can get, I would be down 3,055, whereas at 1840 on this one, I would be down 655. So by looking at both scenarios, being able to click back and forth between the two trades fairly easily, as you can see, you can digest the numbers, you can go up and down the grid and come up with a decision. A lot of people, when they trade, and we'll be happy to do this along with you, might go ahead and have a look at a chart like this, and they say, well, let's see how this looks as a trade when I look at an S&P chart. So they might turn around and say, let me see what price levels I think are realistic on an S&P chart and take it from there. So let me go ahead and bring over an S&P chart for us, and we'll have a quick look at it. And again, this is not intended to be a comprehensive technical analysis. However, it will give you a sense of how you might want to pick a range in this market. So let's say if somebody were to look at this, and you can come up with a series of different conclusions in looking at this chart. It has a number of overlays and other factors which you don't always read. But let's say if somebody looks at this chart and says, you know, I see the market's been, it's here at around 1830 on the weekly as a pretty high level, and you don't think it's going to go much beyond that. You can say, well, I'll write the 1820 call, it's pretty close, or maybe I'll go up to the 1830. So you can look at markets, you can look at all your studies and see based on a chart where is the likelihood and the volatility going to take us. Just do the same on a daily chart. Or say, well, maybe I'm not going to write the 1800 call because if this market bounces, it's very close. We were there not so long ago on a daily chart. I want to have more of a cushion. If somebody thinks that this market's going to bounce strong for any reason, then they would stay away from writing that call outright. One of the things I want to point out here, and it's something that we discussed and something you should be very aware of, is that there are actual measures of volatility. So in a case like this, if you were to say to yourself, if I'm looking for the volatility to drop, it's ideal that the volatility is high now so that relatively speaking, if things get back to some kind of a more normal environment of late, then the following volatility will be there. As you can see here, the volatility is fairly high. We also have a VIX measurement on which we did a webinar, and you can say, well, the volatility is high, and I think the volatility is going to drop. The question is, are you going to say, I think the volatility is going to drop from this large movement, and the market's going to drop, having already dropped this far? That's a decision that you might want to make, and that's why somebody else might write a call on the following basis. Let's say your argument was, well, I think the market's going to go down, but it's already gone down a lot, so it might slow down. That's falling volatility. So if it starts going down slowly, and this volatility here falls from these levels, if you buy a put option, that put option could lose money even if the market goes down. You need rising volatility. And that's why somebody might say, well, I think the market's going to go down, or I think it's going to go down sideways, but I don't think it's going to go up a lot. That's when you turn around and say, I'm going to write an 1820 call. As you can see, that actually works with this moving average here. Or you might say, I'm going to write something higher at the previous highs of 1840 and see if you can collect enough money on an 1840 option to be that out of the money, and if it's worth the risk. So when you look at charts, you're looking for oversold conditions, you're looking for volatility conditions, and for a range of the market. If you think that the market is going to expand its range, then you would definitely be looking to buy premium. If you think that the market is going to narrow its range, then you're going to want to sell premium in anticipation of a falling volatility. So we can actually go ahead and do this with a number of markets. We're also looking for example, and let's run one more trade today. And we were actually asked to do this because we had shown previously some soybean transactions, and then the market tanked. Now it ran back up again. So we've had some questions on what is the look of the soybeans at these levels in terms of writing calls, again, on rising volatility. So I'm going to go ahead and try to run a very quick example on that. We're going to look at the soybean market. Of course, we're going to continue with selling a call. Hold on a second. Just a moment. Let me go ahead and reset this thing. Okay. Okay. And again, we would be selling or writing a call. You remember, again, we get all the soybean contract specs. We get the dialog box with the help links. A reminder that we're looking for volatility to go down and the direction to go down. Let's go ahead and use a single example of the soybean contract, and let's see, where can we collect a good 8 to 10 cents on this, Roy? What do we have as a strike price?
Going to March or out to May?
Let's go ahead and try March.
The 1330 settled at 10.5.
Okay, so we're looking at 1330s. And what you can do, obviously, is you can model out different strike prices in different months and get a different grid. We're looking at intrinsic value here. We're looking at in-the-money value. Obviously, the more time there is in a trade, the more time there is for volatility changes and for price changes to occur. So if we're looking at the 1330 call, and again, you see the strike price examples come up with a dialog box for help. The premium example comes up with a dialog box for help. And let's see just a moment. The premium box now, we have 10 cents.
Yes.
And let's see, I input it as 10. There's no decimal point needed. I'm going to go ahead and use an input number. And let's go ahead now and calculate the trade. Again, I'll remind you, you can save it under a tab, you can print it, you can send it to a friend, or you can post it to a forum. Here we're looking at the 1330 call. 10 cents is 500. We have all the tick values right here, minus the commission or transaction costs and so on. At that structure would bring us to a net to a net credit after all costs have been taken out of $445. The break-even in futures is 1338.90. If you think this market is going to run to 1338 or 1330 quickly with rising volatility, this trade is not for you. The break-even is 0.8.9. So while there is some margin of error in this trade to 1338.90, if the market goes beyond that or the 8.9 cent premium, then the risk begins at $12.50 per tick. Let's see if it's worth it. The person would have to feel that the market's going to stay under there, and then again, if you're bearish, doesn't matter how low the market goes, the most you can make is $4.45 because you collected that premium. That premium does give you the margin of error that although the market right now is higher, your maximum losses there will not begin until you break beyond that premium break even. So you're looking at a market that sells today at let me see here, 1312, I believe. So we have a cushion of 18 cents plus the premium collected and so on. So if you feel that this market's not going to go up more than 20 cents in this time frame, then you would write that call. If you have any reason to think that this market can break out, You have to be cautious. Again, it's a margin trade, so if there's anything out there that could explode volatility to the upside, you do not want to write this call. You want to write this call if you think volatility is going to be dropping or the market's going to be dropping a great deal. If there's something in your formula that says volatility could go up a lot, as you can see here, the risk level may get too high. Once you break 1350, 1360, the numbers can become a little more extreme. And again, you have to go back to the strategy gallery and look for something that will go with your direction with rising volatility if the falling volatility doesn't give you enough of a cushion. Now again, so let's go ahead and actually take this example. And on that theory, let's go ahead and look at how much that option would be in May. And let's have a look at a 1350 May call.
I'm looking it up.
On that?
Yeah, hold on.
Okay. It'll take a second. We're doing this on the fly because we just had the markets close about an hour ago, so we want to give you current levels.
The May 1350 settled at 18 cents.
Okay, now again, we're seeing the May 1350 call. That's 20 cents higher, and it's 18, much more premium to collect, which is 18 cents. Now you see, to do this comparative example, we didn't have to change everything in the grid. All the help menus and items and dialogues are there. All we have to do was change the strike price and the premium, and then we calculate. Now we've got the brand new calculation, and look at this. Now we're collecting a more decent amount of money, collecting 900, and then after costs and fees, it's 845. Like a good business person, you do your math. Your break even on futures now at 1366.90. It's more time left, but now you've got a bigger cushion. Your premium break even is 16.9, and as you can see, your risk on intrinsic futures is above 1366.90 and above 16.9 in premium. And you can monitor both for in the money value and premium value as you go. And as you can see here, if the market goes down, you're bearish, you're collecting a pretty nice premium, and you really start giving up, the place where you start incurring losses is on a significantly larger move to the upside. This is in part because although you're selling an option farther out of the money, there is additional time for volatility, for time value to explode, and because you're looking for time decay or time value to go down, you have a reminder. So you want to make sure during that time frame that if your time decay outlook changes, if the market becomes more volatile, then you just offset the position or you adjust your trade accordingly with a backup strategy. And again, the good thing about doing this and having it register on the brain, and I've done it and I think it works, is that when you are considering two finalist trades, as you may be, and I'm not saying you should consider these because this was an example to demonstrate selling a call. The great thing is that you can go back and forth looking at different prices on the grid, different profit and losses with different strike price and different premiums, compare the two, and then of course you can always take those prices, the comparisons that you make back and forth, get a sense of which range makes the most sense to you, and then select a trade accordingly. And of course you can easily vary position size as well, so somebody might say, well, I'm going to, I like this trade better, but you know what, I'd like to give myself a little more room. Let me go ahead and sell a 1340 call in May, and or let's say a 1350, so there's a more significant difference there. The premium on that would be?
I'm sorry, which was the strike?
The 1350 May soybean call.
Oh, it's 18.
And that was the I'm sorry, the 1370. I'm sorry, I confused the conversation.
Oh, 13.
1370.
It settled at 13 cents.
Okay, so now we're going 20 cents farther out of the money. Therefore, we are collecting less again. But let's see how the trade changes. And again, we just have to change the two little fields. Everything else updates automatically. All your dialog help boxes, the graph remains the same. And now we're seeing another trade where we're collecting less. Again, it's 650, 595 net. But we've got a break even, premium break even at 11.9. and our futures break-even is at almost at 1382, 1381.90. So somebody might say, wow, this really I'm collecting less money, my upside is limited to a maximum of 595. On the other hand, look, I have a lot more room. I wrote at 1370 instead of 1350, and this thing has to get nicely above 1380 before I start giving anything back. And again, 1380 gives you a larger margin of error. You have more time, but presumably if you're watching this market closely, hopefully if you needed to make an adjustment if volatility goes up, you have more of a cushion and more of a margin of error before this option goes in the money. And again, what you can do is compare them side by side, look at one option 1 minute at different prices, look at another option at different prices, and as you go back and forth quickly, maybe making some notes, maybe looking at a chart alongside of these figures, and you will come up with a range. So again, when you write an option like this, the big difference would be that you would pull up a soybean chart and you would go up and down the chart and compare how likely do I think this market is going to go to 1360. How likely is it it's going to go to 1370? Do I think it's going to go to 14? And then setting alerts along the way, if you write these calls, to monitor the risk and to look for an opportunity or for the need to offset, if need be, on that particular trade. So what I find, and in training brokers through and using this option software to train brokers and others, I have found that one of the very useful features is the saving of these trades, the monitoring of these trades, sometimes even watching from day to day. If selling soybean calls, in this case, it's a 1330 March, 1350 May, 1370 May, to be able to go to scroll back and forth, to switch back and forth between the different prices, to have these prices and these levels aligned alongside of a chart so that you can see where those values fall in line with your analysis of the chart, and then to select a trade that makes sense for you across the board. So if we were to take, let's say, a soybean daily chart, let me just bring it over very quickly. Now we've seen all of these different calculations, and we said, well, let's see what's going on in the soybeans. And on this kind of an analysis, one were to say, well, I'm pretty comfortable with the levels on these moves, you can go ahead and we're actually looking at 15. Let's go look at 14. Some of these contracts trade way out, and it's very interesting to compare the different classes of options. What we were looking at here, for instance, as you can see, the real upside move, a level that seems to have held on this market pretty well on the May contract, seems to be around the 1330 level, 1335. We might have had a test near 1350. So when you see something like that, and you say, well, maybe it's going to go here, maybe it's going to go here, but I think it's going to be more in kind of this range. That's why we call it the option ranger, because if somebody said, well, I like the market somewhere between here and here. So if this price were to be and of course we can look at those particular prices using any kind of a tool. I like to use a cursor tool, that is the crosshair. I guess it's like an option ranger. Maybe it'd be like a gun range, like the Lone Ranger. But in any event, so let's say somebody might arguably say, I think the market's going to stay somewhere between here and maybe here. So in a case like this, if you thought the market was going to be somewhere under here, barring major events, you would be interested in selling that call, because anything under that level going down would be a level that would be a good level on this spreadsheet. And again, you can print out the spreadsheet or you can print out the charts and see what the consequences would be of the chart at any of these levels. And certainly when we see the historic levels and the fact that we're challenging some recent higher numbers, in a case like this, the expectation of falling volatility and of staying under those given numbers on that chart, just as an example, would encourage one to go ahead and be a seller of calls. Now, if somebody thought not just that the market's going to go down with diminishing volatility, but they thought it was going to go down very hard. So, and again, I'm not saying that's going to be the case, but let me bring back the chart. So let's say if somebody had more of a view like, I don't think it's getting past here, selling a 13, certainly selling a 1340 call, a 1350 call, a 1330 call is kind of a view that the market's going to stay under this level. However, if you don't just think that it's going to stay under that level somehow, but you think that the market's going to fail here and drop hard, then you would not just be looking for a short or something that was directionally short with falling volatility. If you thought it was going to drop hard, you would look for a short with rising volatility, and that would take us away from the particular trade that we discussed, selling a call. And you say, well, I think it's going to be short with rising volatility, but this is looking for falling volatility. You'd have to go back to the strategy gallery, and you would have to say, well, let me see, what's a good strategy that's directionally bearish? I got my bearish grid, but it's looking for rising volatility. And sure enough, there we are. We've got two choices. One of them we already covered, buying a put. It's on a webinar. That's looking for a drop with rising volatility. And another one is available on our master calculator. Another one is available on our master calculator, which is the put ratio back spread, which is a spread trade. And we're going to be doing some of these more advanced trades next time. In this particular case, you see a bearish direction, rising volatility is buying a put, and of course bearish direction and falling volatility is selling a call. So those are flip sides of that direction and volatility table. I think we've covered most of the basic ingredients. I'm glad we got to go over the soybean trade because it's a level where a lot of people are looking at volatility. Bear in mind that there are volatility measurements on the S&P. We have the VIX on gold, on the dollar, on crude, and so on. So if you want to actually get an objective volatility measurement based on the trading, then that indicator is available to us. It's an indicator that we measure. If you want to look at specific option volatility, you can look at either historic volatility, which is where the history of that option's volatility has been, or you can look at the current implied volatility, which is what the market is factoring in as the volatility price of the option.
Mr. Mueller, before we run out of time, we do have a follow-up question from the webinar we did last Tuesday. The gentleman's asking how much has the VIX gone up since the webinar we had last Tuesday, and what was that move in dollars?
Okay, I haven't looked at the VIX today. I looked at it yesterday because it was such a large move, and we can go ahead and have, maybe you can pull up the VIX price today. I think that we went up about 3. I think we went over 3 as of yesterday. I think we were around 3.2. So
we finished the day at 1825. Last Tuesday it settled at 1410, so it's a little over 4 points.
Oh, wow, 1825 minus 1410. Well, have you ever heard somebody understating a good move? Well, 1825 minus 1410 would be 4.15. So on the VIX futures contract, not including transaction costs, that would have been over $4,000. So it's a very significant move. The VIX is a great tool because many people who are afraid of a big market drop thought of a variety of things to do. They would say, well, should I just sell my stocks? Or they would say, should I buy a put? Or they think, well, what if the government interferes and the thing runs back up again? Or somebody makes a statement. One of the ways to take advantage of things getting more hectic, of people being more nervous, of the anticipation, fear, panic, all those strong emotions that cause volatility to go up, and certainly fear is one of those things. then the VIX will get higher. The VIX, or the volatility index, will go up. So that is an instrument that you can use, and generally speaking, the volatility tends to be, the VIX tends to be higher on large drops. So if you have a bias for a drop but are afraid of going short outright, you can look at, and the VIX is low, then you can look at the VIX as another way to speculate on how volatile the market's going to be. And you can certainly use it in combination with other things as well. So it's a way of hedging direction or hedging premium risk if you are using option strategies. That was a very large move in the VIX. It's very difficult to say if it's going to back off. Usually you want to buy it in the low double digits if at all possible, and barring any major lasting disasters, when it does go up, you can look to offset or you can look to reverse. By the way, the VIX has a futures contract. There are no options contracts on it. So if you want to do something in the VIX and you have a preference for options, you might look either for a way to do something in the options or in a way to combine the VIX with the instrument options to try to better gauge your direction and your volatility expectations. Do we have anything else?
No, that's the only question today.
Oh, thank you for the question. By the way, again, past performance is not indicative of future results. We want people to learn the VIX, and whether we have the direction right one week or wrong the next, what we're really doing here is trying to show people how to use a tool. And obviously, nobody gets individual trading advice or customized trading advice during an educational process. That has to be part of a brokerage relationship where you talk to somebody about your personal expectations, your personal finances, because a spreadsheet is a great tool, but different spreadsheets and different levels of risk and reward are suitable for different people. So a spreadsheet is objective and it's an educational tool, but every person's needs and risk tolerance are different, and making trading decisions in large part is also based on those personal ingredients of expectation, of risk tolerance, and a number of other factors. So please be sure to think everything through, read your disclosures, do your math, and if you have any questions, be sure to talk to your broker or professional to review these trades and make sure that they're suitable for you.
Thank you, Mr. Miller.
Okay, everybody have a super day. We're going to see you again on Thursday. We're going to do the opposite side of this trade. Instead of selling a call, we're going to talk about selling a put. So that means that's for a market where expectation is for prices to go up and for volatility to go down. So I'm looking forward to Thursday's selling a put program. Have a great afternoon.
Thank you.